I think the most important point here is to take a step back and to realize that we are not yet in the final sprint to the end game, because the next printing round hasn't even started yet. Right? The reverse repo extra money bank has been depleted, but the Fed hasn't stopped QT, hasn't stopped shrinking its balance sheet. It's slowed it down, but it hasn't stopped it. It hasn't cut rates to zero, and it hasn't started buying bonds net yet. It just, nothing is happening. And the fact that gold has gone so far so fast before the next printing round has even started, it kind of surprised me. So my point is that gold is not going to go up and up and up and up every single day until the next printing round starts. I mean, just like it was in COVID, you know, the Fed cutting to zero immediately because there's a bank scare, or JP Morgan says they have to. Whatever it is, the big banks come together and say, Fed, we need you to move. Reverse repos are done. There's practically no more of them. I think the last one was like 3 billion, which is basically nothing. So the quantitative tightening, the QT, the shrinking of the balance sheet that the Fed has engaged in since it started at the peak of the balance sheet was sometime in 2021 for the last 4 years, maybe 2022. I don't remember. It's all blurring together. All this COVID and the printing and AI, it's all kind of like mushing together in my head. Whatever's happening in the world. So since the Fed started QT, they've been shrinking effectively the reverse repo amount, which is money that's outside of the banking system, and now it's no more. So all the QT is it has been draining bank reserves, and bank reserves are used as the grease, as the slime that coats the repo market. That's the money that's being traded. Those are the dollars that are being traded every night, 3 trillion of them, the bank reserves. Now, I had a theory which ultimately proved wrong. I don't think it's in principle wrong. I just think that I missed a technical aspect that I suspected I might have missed, but I didn't really take it seriously. I thought that the amount of reserves could not be less than the amount of repos that are traded every night, because they're trading the reserves.
To appreciate what's happening, we step back to the mechanics. In a classic reverse repo, the Fed sells securities to a counterparty with an agreement to buy them back later, a tool to temporarily reduce bank reserves. Meanwhile, in the repo market, banks and funds borrow and lend reserves and collateral. Bank reserves are the grease of this system. With the Fed's balance sheet now shrinking, quantitative tightening or QT, the pool of bank reserves has been forced lower. As reserve balances fall, the funding pressures deepen, raffling the midnight repo market and prompting interest rate volatility.
So it turns out they can. I just don't know by how much. I don't think by that much. So right now the ratio, the bank reserves are falling. They're now at like 2.9888 trillion, like below 3 trillion. And this week's number, which should be out in a few hours, I think 2.5 hours it'll be out, and I'll check it. It should be like something like $80 billion less, because the government shutdown, right? It means that the government isn't spending as much money. It's spending, I think, on mandatory spending, but not on discretionary or something like that. I don't know exactly what the technical details are, but it's spending less money than it otherwise would. So all the money that's sucking out of the bank system is not being spat back into it. So they're raising money. I think the total dollar cash hoard that they have is like $930 something billion. It was whatever it was like 60 or 70 billion dollars more than it was last week. So that's money that's taken from reserves. So yeah, now you have 2.988 trillion minus about 70 billion. So it's like 2.91 trillion or something. And the amount of repos that are being traded is over $3 trillion. It's like 2.98. It fluctuates between like 2.95 trillion and 3.0 or 3.1 trillion, something like that. Like how much longer can this go on? I mean, we're looking at the repo rate. It's called the SOFR rate, and it keeps wobbling. It wobbled again 2 days ago, up 7 basis points, and now it was down 3, and tomorrow it could be up 10. Who knows? If it's already wobbly, that means things are already tight. And the standing repo facility that the Fed instituted after COVID, it provides emergency repo money to banks that can't get it because maybe the reserves have run out. It's being used and sparingly, like a few $1 billion a night, but it is being used now. It wasn't being used before. So we know that some banks are out of reserves, so they can't get any. So there is a shortage here. It's going to get worse as repo trading keeps expanding as it does, because you have all these hedge funds that are, I don't know, trying to pick up pennies with basis trades. I don't even want to go into the technicals of that. It's just they're trading around dead zombie money and earning a few pennies on levering it up like 50 times each night. So this is going to end. It's going to end soon because the repo rate is already moving several basis points a night. It's already tight.
Data now illustrate the pressure. With reserves reportedly under $3 trillion, yet daily repo volumes still tracking above $3 trillion, the ratio of reserves to repo trading has crossed a critical threshold. The repo rate, as proxied by the SOFR rate, is flickering, moving by several basis points a night, a clear sign of tight funding conditions. The Fed's standing repo facility, introduced after the COVID shock, is being utilized again, albeit at modest levels, indicating that banks are short of reserves and reliant on central bank backstop liquidity. The mismatched flow of reserves and overnight funding is a red flag for liquidity fragility.
I think the most important point here is to take a step back and to realize that we are not yet in the final sprint to the end game, because the next printing round hasn't even started yet. Right? The reverse repo extra money bank has been depleted, but the Fed hasn't stopped QT, hasn't stopped shrinking its balance sheet. It's slowed it down, but it hasn't stopped it. It hasn't cut rates to zero, and it hasn't started buying bonds net yet. Nothing is happening. And the fact that gold has gone so far so fast before the next printing round has even started, it kind of surprised me. So my point is that gold is not going to go up and up and up and up every single day until the next printing round starts. I mean, just like it was in COVID, the Fed cutting to zero immediately because there's a bank scare, or JP Morgan says they have to. Whatever it is, the big banks come together and say, Fed, we need you to move. And then they print twice, 3 times, 4 times as much money as they did during COVID. Then gold and silver should go up and up and up day after day after day without any kind of pullback at all. But we're not there yet. So until we are there, the dollar is going to be in a perpetual short squeeze, meaning there's always more debt than dollars exist.
What does this mean for precious metals in the dollar system? The monetary plumbing now is precarious, yet the true printing phase has not fully begun. The Fed hasn't cut rates to zero or restarted large-scale asset purchases, so we are not in the final sprint scenario. Meanwhile, in a world of ever-expanding debt versus dollars, the greenback is caught in a perpetual short squeeze. For gold and silver, this means the upside pressure exists, but isn't yet unchecked. Silver outperforming gold would typically signal a breakdown in credit flows. That signal remains muted. Until the next monetary bulge kicks off, expect volatility rather than unrestricted ascent.
So at the point when somebody starts defaulting, then you have, it's like a game musical chairs where the music stops and everybody's got to sit down, and whoever sits down last doesn't get a chair. So when the music stops and the defaults start, that's when there's a rush for dollars, and there's going to be a big rush for dollars at some point, and gold and silver are going to sell off just like everything else. It's just that gold is going to sell off less than everything else, just like it did in COVID. Gold sold off during the lockdowns. It did, and it reached a low of 1450, and the miners got clobbered, I don't know, 20, 30, 40% in a few days. I don't know if it's going to be that magnitude this time. It's going to be the same kind of thing. And then the Fed's going to reinflate. And then at that point, we can say we're in the final sprint. It's going to take a few weeks until the dollar collapses. But we're not there. We got to wait for that to happen. And meanwhile, we can play the game of, well, what was the proximate cause that made gold and silver fall down specifically on October, whatever it was, 21st. And then we could look at the movements in the market. But that's all inevitable. It's always the same story. There's going to be something that is going to cause a correction until the Fed reinflates. So wait for that to happen. And then you can say that there's going to be no more corrections. But until then, you got to stay balanced. We can't be too euphoric and we can't be too discouraged because we're still in a dollar short squeeze where there's more debt than dollars that exist. And that's what's going to happen.
Historically, every time the system has reset, such as post-1918, 1968 to 80, or 2011, silver has outridden gold strongly. In such episodes, credit breaks, central banks intervene, reinflate, and the metals surge. Silver outperforming gold has been a warning flag of systemic distress and reinflation to come. The silver-to-gold ratio today, around 81, is well down from its highs near 107:1, but it's still far from historic peaks seen at crises. If the ratio collapses towards 15:1, it might mark the event, but we are not there yet. With credit stretched and monetary policy still in tightening mode, the signal remains deferred.
Yeah, you can come up with 1,000 reasons why it happens. But before we go into the reasons why, we just have to remember that this is what has happened every time since 1918, since the end of World War I, which was the end of a huge inflation that funded the Great War back then. And then at the end of that inflation, silver outperformed gold until a silver dollar was worth more than a gold dollar. Not that silver was worth more than gold, but if you had a silver dollar coin versus a gold dollar coin, I think they had those coins back then the silver dollar was worth more than the gold dollar. So it was 1918 was the first time this century. You had it in 1968, 1980, 2011. Every single time there's some sort of a monetary reset, minor or major, then silver always handily outperforms gold. Like, obviously, what's that word? Not sporadically. Like in a frenzy. There's just a huge bid for silver, and we didn't see anything near that at all. Like we were applauding, and we were giving a nice little polite round of applause to silver when it finally caught up to the rate that gold was rising, and even that wasn't every day. And so maybe since since August or September, silver has very slightly outperformed gold. But so I went from a ratio of 107:1 in April to now 80:1 a few days ago. So okay, fine, it's a little bit of an outperformance, but you're counting from 107. That's not a normal ratio. So whatever is happening now, it's not an intermediate top. If it is a major top, it would be like any of the other ones that we've experienced since 1918.
So where do we stand, and how should one navigate? We are in the interlude. The Fed is still draining liquidity, credit remains under pressure, and the dollar remains structurally squeezed. But the dramatic endgame, rapid reinflation, sweeping asset price rises, metals rockets, awaits the trigger, a major default, policy reversal, or banking shock. Until then, markets might swing, correct, and surprise. Portfolio discipline matters. Stay balanced, be ready, but avoid euphoric leaps. The next major leg will arrive, but timing is opaque. Recognizing the plumbing, reading the signals, reserve drains, funding stress, ratio shifts is the edge.
If you want to go into the why, it depends where your vision is most keen, what aspects of the gold and silver market you connect to or you look at, are you able to analyze the best? And I'm always broadly monetary. So whenever silver outperforms gold, it's a signal that credit is breaking down. And either the Fed intervenes and it saves the credit market by adding more credit. Adding more credit means adding more debt, because it's the same thing. Credit and debt are two sides of the same coin. So if the Fed's able to add more credit, add more debt, and then it's like a borrower who you're demanding he pay you back, and then he gets more credit from someone else, and he's able to pay you back in credit, and you're like, okay, fine. So I'll extend the term on your loan, and you'll keep giving me this credit. So that's what the Fed does. It just keeps extending the loan. So as long as it can do that, it can calm down the money markets and expand the credit markets. But when silver outperforms gold, that means either the Fed has to reinflate and suppress the monetary prices in terms of credit, or it's done. And this time they'll try to reinflate, and it won't work. It'll be done. And we're just waiting for that last surge of silver over gold. It's going to end somewhere around 15 to 1. We don't know exactly when, but my guess is there's a bank crisis of some sort. The Fed cuts to 0, starts QE again, and then the metals just go up, limit up one day, limit up day 2, limit up day 3, limit up day 4. It's going to be like the end of 1979, the beginning of 1980, except this time there's going to be no correction back down.